Kareem Sirageldin was once a star in global finance, a managing director at Credit Suisse, one of the world's most powerful investment banks. Born in Cairo and educated at Yale, Kareem built a reputation as a brilliant mind in the complex world of structured credit. From the bank's trading floors in New York and London, he managed portfolios of mortgage-backed securities during the height of America's housing boom, making millions for the firm and earning a name as one of its most trusted risk-takers. But when the U.S. housing market began to collapse in 2007, so did the paper empire that fueled it. As home prices plummeted and investors panicked, the value of mortgage bonds held by Credit Suisse dropped sharply. Instead of marking down those losses, prosecutors said Kareem directed traders under him to inflate bond values on the bank's books, hiding hundreds of millions of dollars in losses. The falsified prices gave the illusion that the portfolio was stable, preserving bonuses and investor confidence at a time when the entire financial system was shaking. In 2013, Kareem pleaded guilty to conspiracy to falsify books and records of a financial institution. Federal prosecutors called it a rare example of accountability from Wall Street's upper ranks in the aftermath of the 2008 crisis. U.S. District Judge Alvin Hellerstein sentenced him to 30 months in federal prison, calling his conduct a small piece of an overall catastrophe. When Kareem reported to prison, he became one of the only senior bankers in the world to serve time for crimes directly tied to the financial crash. His case symbolized both the massive moral failures of the era and the limited justice that followed. Released in 2016, Kareem largely disappeared from public life, but his name endures as a cautionary tale of how a few deceptive numbers can ripple through an entire financial system. Case 2. R. Alan Stanford lived the life of a Wall Street legend and a global billionaire. Born in 1950 in Mexia, Texas, he built the Stanford Financial Group, headquartered in Houston, into what appeared to be a respected international banking empire. His offshore institution, Stanford International Bank in Antigua, promised investors safe, high-yield certificates of deposit that seemed immune to market swings. With branches across the Americas and a polished image of success, Stanford presented himself as a visionary banker, a man who had mastered both finance and charm. But behind the lavish offices and high returns, the foundation was fraudulent. For over 20 years, Stanford orchestrated a massive $8 billion Ponzi scheme, using new investors' money to pay existing ones while secretly diverting funds to finance his extravagant lifestyle. He bought yachts, private jets, and mansions around the world, while his bank claimed to be one of the most stable and profitable offshore institutions in existence. The truth began to unravel in 2009, when the U.S. Securities and Exchange Commission, SEC, accused Stanford and his executives of running an international fraud operation. Federal investigators discovered that the promised investments were largely fictitious and that much of the money was used to cover personal expenses and prop up the illusion of success. In 2012, after a 6-week trial in Houston, Stanford was convicted on 13 counts, including wire fraud, mail fraud, conspiracy to commit money laundering, and obstruction of justice. The evidence was overwhelming. Billions of dollars had vanished, and thousands of investors across more than 100 countries were left in financial ruin. That same year, U.S. District Judge David Hittner sentenced Stanford to 110 years in federal prison, one of the longest sentences ever handed to a financial executive. The court also ordered the seizure of his remaining assets to partially compensate victims, though most lost nearly everything. Stanford's fall from grace was complete. Once knighted by the Antiguan government and hailed as a symbol of success, he became an emblem of financial deceit and corruption. Today, Alan Stanford remains behind bars, a reminder that no amount of prestige or power can shield a banker from the consequences of betrayal and greed. Case 3. Robert Randall Jones was once a respected figure in Georgia's community banking sector, known for his skill in commercial lending and leadership at Community Bank and Trust. Born in the early 1960s, Jones had built a career marked by diligence, professionalism, and close ties to clients and local businesses. Colleagues often praised his strategic insight and ability to manage complex loans, making him a trusted authority within the bank. However, behind this respected image, Jones orchestrated a conspiracy to defraud Community Bank and Trust, exploiting his position for personal gain. Over several years, he manipulated loan documents, approved fictitious loans, and diverted bank funds into accounts he controlled. His actions went beyond simple mismanagement. They represented a deliberate and calculated abuse of authority. The fraudulent scheme had far-reaching consequences. The bank suffered significant financial losses, and numerous local businesses and depositors were affected. As federal investigators uncovered the deception, Jones's reputation crumbled, revealing the stark contrast between his public persona and private misconduct. Authorities emphasized that the scheme not only violated federal law, but also undermined the trust foundational to community banking. In 2011, Robert Randall Jones was sentenced to 10 years in federal prison, followed by 5 years of supervised release. The court noted the severity of his breach of fiduciary duty and the deliberate nature of the fraud, stressing that leaders entrusted with public funds bear a heightened responsibility for ethical conduct. His sentence was accompanied by restitution requirements to partially address the financial harm caused to the institution and its clients. By the way, just before we get into the next case, if you're new to the channel, please comment where you're watching from. I'd love to say hello to you in the comments. Thank you. Case 4. James Blose was once regarded as a trusted legal mind in American banking, serving as general counsel for multiple financial institutions. Known for his meticulous attention to detail and understanding of complex financial regulations, Blose enjoyed a career that many aspiring bankers and attorneys admired. His legal expertise placed him at the center of his bank's operations, overseeing compliance, contracts, and internal controls, a position that demanded integrity and a sharp ethical compass. However, behind the facade of professionalism, Blose orchestrated a decade-long embezzlement scheme that would ultimately destroy his career and tarnish the institutions he served. Between 2008 and 2018, Blose systematically diverted $7.4 million from the bank's accounts, exploiting his access to financial records and authority over transactions. By manipulating documentation and concealing withdrawals, he created the appearance of routine banking operations while quietly funneling funds into personal accounts. For years, his actions went undetected, allowing Blose to enjoy the trappings of wealth and success, luxury vehicles, high-end real estate, and an elevated social standing within the banking community. But as financial audits became more rigorous and discrepancies accumulated, federal investigators uncovered the scheme. The investigation revealed both the scale of the embezzlement and the trust Blose had violated in his role as general counsel. In 2025, James Blose was sentenced to 48 months in federal prison, followed by 3 years of supervised release. The court emphasized the breach of fiduciary duty inherent in his position and the calculated nature of his misconduct. Additionally, Blose was ordered to repay the stolen funds, though the restitution could never fully reverse the harm inflicted on the banks and their customers. Case 5. Robert John Hager, once the respected CEO of Border State Bank in Greenbush, Minnesota. Robert John Hager was known for his polished leadership and deep connections in the local banking community. Born in the early 1960s, Hager worked his way up through the ranks of community banking, earning a reputation for competence and trustworthiness. Under his stewardship, the bank was considered stable and reliable, serving families and businesses throughout the region. Hager's career, however, took a dramatic turn that would overshadow years of professional accomplishments. In 2021, federal prosecutors revealed that Hager had falsified bank records and misappropriated more than $1.6 million from the institution he led. Using his authority as CEO, he created false entries in financial statements to divert funds for personal use, all while maintaining the appearance of a thriving bank. The misappropriation stretched over several years, during which Hager's deceptive practices went unnoticed by auditors and colleagues alike. The losses shook Border State Bank and sent ripples through the local community, undermining trust in the very institution Hager had been entrusted to lead. Regulators and law enforcement viewed the breach of fiduciary duty as severe, noting that the scheme demonstrated both premeditation and exploitation of a position of power. In court, Hager pled guilty to federal charges of bank record falsification and misappropriation of funds. In June 2021, he was sentenced to 18 months in federal prison, a sentence that underscored the seriousness of his actions. Beyond prison, Hager faced restitution obligations and a permanent stain on his professional reputation. Case 6. Charles Keating. Few names in American banking history carry as much infamy as Charles Keating, the man whose actions helped ignite the savings and loan crisis of the 1980s, one of the largest financial scandals in U.S. history. Born in Cincinnati, Ohio in 1923, Keating was ambitious, articulate, and fiercely driven. Before entering finance, he built a career as a lawyer and businessman, eventually founding American Continental Corporation, a Phoenix-based real estate and investment firm. In 1984, Keating purchased Lincoln Savings and Loan Association in California. Under his leadership, Lincoln rapidly expanded, taking aggressive risks that defied traditional banking prudence. Keating directed billions of dollars into speculative real estate projects and high-yield junk bonds, chasing massive profits during an era of deregulation. For a while, it worked. Lincoln appeared to be thriving, and Keating's fortune and political influence soared. Behind the scenes, however, the institution was deteriorating. Keating had encouraged the sale of risky, uninsured bonds to ordinary customers, many of them retirees, falsely assuring them of safety. When the real estate market faltered, Lincoln's empire crumbled. By 1989, the federal government seized Lincoln Savings, citing more than $3 billion in losses. The collapse left thousands of investors ruined and taxpayers on the hook for massive bailout costs. Keating was accused of fraud, racketeering, and conspiracy. In 1991, he was convicted and sentenced to 10 years in prison on state charges, and later faced federal convictions as well. Though some of his convictions were overturned on appeal, he ultimately served over 4 years behind bars before being released in 1996. The scandal also tainted several U.S. senators, known as the Keating Five, who were accused of improperly intervening on his behalf. Charles Keating died in 2014. By the way, I'm going to be posting a lot more interesting videos on the channel. I would greatly appreciate it if you could show your support by liking this video and subscribing to the channel. Thank you. Case 7. Lawrence E. King, Jr. Once a rising figure in Nebraska's financial scene, Lawrence E. King, Jr. built an image of success, ambition, and influence until his empire collapsed under the weight of massive fraud. Born in the United States in 1944, King managed the Franklin Community Federal Credit Union, FCFCU, in Omaha, Nebraska, which served primarily low-income families. Charismatic and politically connected, he cultivated relationships with local leaders and positioned himself as a pillar of the community. Under the surface, however, King was running one of the most brazen embezzlement schemes in U.S. banking history. Over several years in the 1980s, he diverted millions of dollars from the credit union for personal use. He funded an extravagant lifestyle, luxury cars, expensive clothes, and lavish parties, all financed by the money of hardworking depositors who trusted him. In 1988, federal auditors discovered massive discrepancies in FCCU's accounts, prompting an investigation by the FBI and the National Credit Union Administration, NCUA. The findings were damning. King had embezzled over $38 million, collapsing the credit union and leaving hundreds of members financially devastated. In 1991, Lawrence E. King, Jr. pleaded guilty to fraud and embezzlement. He was sentenced to 15 years in federal prison, a dramatic fall for a man once celebrated as a symbol of local economic progress. His case drew national attention not only for the scale of the fraud, but also for exposing how weak oversight and political favoritism allowed corruption to thrive in small financial institutions. After serving part of his sentence, King was released quietly, living far from the spotlight he once craved. The collapse of Franklin Credit Union remains one of the most shocking examples of betrayal within America's banking system, a story of how power and greed can devastate the very communities a banker is meant to uplift. Case 9. John Rusnak. Before his downfall, Rusnak was a high-flying currency trader at All First Bank, a Maryland-based institution owned by Allied Irish Bank's AIB. Born and raised in the United States, Rusnak joined All First in the 1990s as part of its foreign exchange trading team, handling complex bets on the movement of global currencies. He was seen as talented and confident, the kind of risk-taker banks prized during the booming financial years. But beneath his calm exterior, Rusnak was concealing a devastating secret. In an effort to cover up mounting trading losses, he began falsifying records, fabricating option contracts, and manipulating spreadsheets to make it appear as though his trades were profitable. For years, the deception went unnoticed. Allfirst's risk management systems, supposedly designed to catch such misconduct, failed to detect his schemes. By 2002, the truth exploded into public view. Rusnak had lost $691 million, one of the largest banking losses ever recorded in the United States at the time. The scandal sent shockwaves through both American and Irish financial markets, wiping out investor confidence and forcing sweeping reviews of internal controls across the industry. Federal prosecutors charged Rusnak with bank fraud and false accounting. In 2003, he pleaded guilty, admitting that he had lied to everyone to hide his mistakes and delay the inevitable reckoning. The court sentenced him to 7.5 years in federal prison, along with an order to pay $691 million in restitution, a sum he could never realistically repay. While in prison, Rusnak cooperated with investigators and expressed remorse, saying his obsession with fixing his losses had consumed him. Case 10. Timothy Leissner, charismatic, polished, and well-connected. Timothy Leissner once embodied the global reach and influence of Goldman Sachs. Born in Germany, Leissner built his reputation as one of the bank's most powerful rainmakers in Asia, cultivating relationships with political and business elites from Singapore to Malaysia. But behind his success lay a web of deception that would ultimately destroy his career and freedom. Leissner was the key architect of Goldman Sachs's involvement in the One Malaysia Development Berhad 1 MDB Fund, a Malaysian state-run investment project meant to spur national growth. Between 2012 and 2013, under Leissner's leadership, Goldman arranged 3 massive bond offerings totaling $6.5 billion. The deals earned the bank hundreds of millions in fees, but much of that money never reached its intended projects. Instead, billions were siphoned off by corrupt officials and financiers, fueling lavish lifestyles that included luxury yachts, jewelry, and even the financing of Hollywood blockbusters. In 2018, U.S. prosecutors charged Leissner with conspiracy to launder money and violate the Foreign Corrupt Practices Act, FCPA. He pleaded guilty, admitting to bribing officials in Malaysia and Abu Dhabi to secure lucrative deals. As part of his plea, Leissner agreed to forfeit $43.7 million and cooperate with investigators, a decision that later helped convict his colleague. Roger Engel. Leissner's personal life also became tabloid fodder. During court proceedings, it was revealed that he had maintained multiple marriages simultaneously and forged divorce documents to deceive one of his wives, a detail that painted him as a man willing to lie not only in business, but also in life. In 2025, after years of cooperation and delay, a U.S. judge sentenced Leissner to 2 years in prison, noting his pivotal yet remorseful role in the scandal. Once one of Goldman's most admired dealmakers, Leissner's story is now a striking lesson in how ambition without integrity can turn global success into public disgrace. Case 11. Angelo Mozilo was once hailed as a visionary who helped millions of Americans buy homes. Born in 1938 in the Bronx, New York, Mozilo co-founded Countrywide Financial in 1969 and built it into the largest mortgage lender in the United States. His company symbolized the dream of home ownership, offering loans to families who had long been excluded from traditional banking systems. By the early 2000s, Countrywide controlled nearly 20% of the U.S. mortgage market, and Mozilo's name became synonymous with financial success. But the empire he built would later be blamed for fueling the 2008 financial crisis. Under Mozilo's leadership, Countrywide aggressively pushed subprime loans, risky mortgages often given to borrowers who couldn't afford them. When the housing bubble burst, millions of Americans lost their homes, and the company's practices came under intense federal scrutiny. Emails later revealed that even Mozilo privately described some of the loans his firm issued as toxic. In 2009, the U.S. Securities and Exchange Commission charged Mozilo with securities fraud and insider trading, accusing him of misleading investors while secretly selling hundreds of millions in company stock before the crash. He avoided prison through a massive settlement, but was permanently barred from serving as an officer or director of any public company and paid $67.5 million in fines, one of the largest penalties ever imposed on a banking executive at the time. Case 12. Russell Laffitte was a South Carolina banker whose name became linked to one of the most talked about financial scandals in recent years. Born in Hampton County, he worked his way up through the ranks of Palmetto State Bank, eventually becoming its CEO. Known locally for his deep family roots and trusted reputation, Laffitte was long considered a pillar of small-town banking, someone who understood his community and the importance of accountability in financial stewardship. That trust was shattered when investigators revealed that Laffitte had helped disgraced attorney Alex Murdaugh steal hundreds of thousands of dollars from clients' legal settlements. Using his authority as a banker, Laffitte funneled funds through client accounts, approved improper loans, and moved money to conceal thefts. His actions, prosecutors said, weren't mistakes. They were deliberate financial maneuvers that enabled fraud and betrayed both his customers and his bank. In August 2023, Laffitte was convicted in federal court of wire fraud, bank fraud, and misapplication of bank funds. He was sentenced to 7 years in federal prison and ordered to pay restitution. In 2025, he also received a concurrent 5-year state sentence for related crimes. The case marked a rare instance of a small-town banker being held criminally responsible for aiding a powerful client's corruption. Case 13. Bradley Birkenfeld began his career in banking as a private banker and wealth manager, working for institutions including Credit Suisse and UBS. Born in 1965 in Massachusetts, he was part of the elite circle of international bankers, advising ultra-wealthy clients on cross-border asset strategies. His role positioned him at the heart of global banking's secretive world of private client accounts and offshore finance, where anonymity and tax minimization were prized above all. In the mid-2000s, Birkenfeld began uncovering a vast system of U.S. taxpayers hiding assets in Swiss banking accounts under uncleared obligations. In 2007, he made the so-called Birkenfeld disclosure to U.S. authorities, revealing how UBS was helping American clients evade taxes. Despite acting as a whistleblower, Birkenfeld himself was later charged by the United States Department of Justice, DOJ, for his role in a conspiracy to defraud the United States, essentially for facilitating the very system he exposed. In 2008, Birkenfeld pleaded guilty to 1 count of conspiracy to defraud the United States. He was sentenced to 40 months in federal prison and fined $30,000. His cooperation in the UBS case, however, led to the recovery of hundreds of millions in U.S. tax revenue, and he received a whistleblower award of $104 million from the Internal Revenue Service, IRS. Even so, his time behind bars and the controversy around his dual role as both participant and informant marked a complex chapter in American banking history, one in which secrecy, regulation, and ethics collided. Case 14. Stephen M. Kalk was once a respected figure in American banking, known for his role as founder, chairman, and CEO of the Federal Savings Bank in Chicago, Illinois. Born in 1964, Kalk built his reputation as a confident and ambitious banker with strong ties to both finance and politics. Under his leadership, the bank expanded rapidly, offering mortgages and business loans to clients across the country. Kalk often presented himself as a patriotic executive who blended economic expertise with national service. But his ambitions eventually led him across a dangerous line. In 2016, Kalk used his position to approve $16 million in risky loans to Paul Manafort, the former campaign chairman for Donald Trump, while secretly seeking political favors in return. According to federal prosecutors, Kalk wanted a senior position in the new administration, including possible appointments as Secretary of the Army or Treasury. His emails and memos revealed a deliberate plan to trade bank funds for personal advancement. In 2021, Kalk was convicted in federal court of financial institution bribery and conspiracy. A year later, in February 2022, he was sentenced to 1 year and 1 day in federal prison, fined over $1 million, and banned from working in the banking industry again. Case 15. Mark A. Connor was once the confident face of small-town American banking. Born in Georgia, he rose through the ranks of the financial world to become president and chief executive officer of First City Bank of Stockbridge, a federally insured institution south of Atlanta. Connor was known for his sharp suits, his steady presence, and his ability to bring in investors who believed their money was safe under his watch. To his community, he represented trust, the kind of banker who embodied old-fashioned financial stability. But behind the polished image was a web of deceit. Investigators discovered that Connor had secretly manipulated bank records, falsified asset reports, and funneled millions through shell companies and offshore accounts in the Cayman Islands. When the housing market collapsed, First City Bank was left on the edge of failure, and regulators began to uncover the full scope of the fraud. The bank's downfall cost the Federal Deposit Insurance Corporation, FDIC, nearly $30 million, making it one of Georgia's most damaging bank failures during the financial crisis. In 2012, Connor pleaded guilty to bank fraud, conspiracy, and perjury. A federal court sentenced him to 12 years in prison and ordered him to pay $19.5 million in restitution while forfeiting another $7 million in assets. Prosecutors said his crimes were a complete betrayal of both his bank and his community. Case 16. Martin Dodgson was a former managing director at Deutsche Bank in London, whose career ended in disgrace following his conviction for insider trading. Born in the United Kingdom, Dodgson had a notable career in investment banking, having also held positions at Lehman Brothers and Morgan Stanley. He was involved in high-level financial advisory roles, including advising the UK government during the 2008 financial crisis. Dodgson's downfall began with his involvement in a conspiracy to trade on confidential information about upcoming corporate deals. Between 2006 and 2010, he provided insider information to his close associate Andrew Hind, a former finance director at Topshop. Hind then used this information to make illicit trades, resulting in significant profits. The scheme was uncovered after an extensive investigation by the UK's Financial Conduct Authority, FCA, leading to their convictions. In May 2016, at Southwark Crown Court, Dodgson was sentenced to 4.5 years in prison, the longest sentence ever handed down for insider trading in the UK at that time. Hind received a 3.5-year sentence. The court described their actions as persistent, prolonged, deliberate, dishonest behavior. Following the conviction, the FCA issued a confiscation order requiring Dodgson to pay £1.07 million, representing the proceeds of his criminal activities. Failure to comply would result in an additional prison term. This case highlighted the severe consequences of insider trading and underscored the importance of maintaining integrity within the financial sector. Case 17. Kweku Adeboli was a British banker who rose through the ranks at UBS, one of the world's largest investment banks, to become a trader in its London office. Born in Ghana and raised in the United Kingdom, Adeboli built a reputation for exceptional quantitative skills, ambition, and a knack for high-risk trading strategies. Colleagues described him as charismatic and driven, qualities that initially made him a promising figure in UBS's operations. Adeboli's career became infamous following the 2011 trading scandal at UBS, which resulted in a £1.4 billion loss for the bank. Using unauthorized trading strategies, he concealed massive positions and manipulated records to hide the scale of his trades. The collapse exposed weaknesses in internal controls and risk management at UBS, shaking confidence in London's financial markets. In 2012, Adeboli was convicted of fraud and false accounting at Southwark Crown Court. The prosecution demonstrated that his actions were deliberate, not accidental, as he knowingly bypassed risk limits and falsified trading documents to benefit personally and protect his standing within the bank. He was sentenced to 7 years in prison, highlighting the severity of misconduct at the highest levels of banking. Case 18. Tom Hayes was a British banker whose career in high-stakes trading ended in notoriety following his conviction for manipulating the London Interbank Offered Rate, LIBOR. Born in England, Hayes rose through the ranks of UBS and later Citigroup in London, where he specialized in derivatives trading, particularly in interest rate products. Colleagues described him as ambitious, highly analytical, and fiercely competitive, qualities that initially made him a promising figure in the financial markets. Hayes became a central figure in the LIBOR scandal, one of the most significant financial manipulations of the 21st century. Between 2006 and 2010, he engaged in a scheme to manipulate benchmark interest rates to benefit his trading positions, submitting false estimates and coordinating with other traders to distort LIBOR rates. This manipulation affected billions of dollars in financial contracts worldwide and contributed to a profound loss of trust in global financial markets. In 2015, Hayes was convicted at Southwark Crown Court of conspiracy to defraud, marking one of the first criminal prosecutions in the UK for LIBOR-related misconduct. He was initially sentenced to 14 years in prison, later reduced to 11 years on appeal. His conviction highlighted the deliberate and sophisticated nature of his actions, which went beyond mere corporate misconduct to constitute criminal fraud. Case 19. Christian Littlewood was a British banker whose career in investment banking ended in disgrace following his conviction for insider dealing. Born and raised in the United Kingdom, Littlewood built a promising career at a major London-based investment bank, specializing in corporate advisory and trading. Colleagues described him as highly analytical, ambitious, and well-connected, qualities that initially positioned him as a rising star within the financial sector. Littlewood's downfall began between 2006 and 2008 when he exploited confidential, price-sensitive information about upcoming corporate transactions. Using his access as a banker, he executed trades on his own account and indirectly through associates, generating substantial illicit profits. The scheme involved careful concealment of his trades to avoid detection, demonstrating a sophisticated understanding of both the markets and regulatory oversight. Ultimately, the Financial Services Authority, the UK's financial regulatory body at the time, uncovered the misconduct, triggering an investigation that led to Littlewood's arrest and prosecution. In February 2011, at Southwark Crown Court, Littlewood pleaded guilty to 8 counts of insider dealing. He was sentenced to 40 months in prison, reflecting the seriousness of his actions and the deliberate breach of trust inherent in his conduct. The court highlighted that his trading scheme not only undermined market integrity, but also eroded public confidence in the financial system. A confiscation order was also imposed, requiring Littlewood to repay the proceeds of his illegal gains, ensuring that crime did not pay. If you enjoyed this video, I'll be posting many more interesting videos on the channel. I'd greatly appreciate it if you could like and subscribe. Thank you very much.